Q2 2026 earnings for Wheaton Precious Metals, ticker WPM. And depending on which trading desk you're sitting at today, their adjusted EPS of $1.19 was either a solid beat against a $1.14 consensus
or a slight miss, right, against those more aggressive $1.24 models. But, I mean, the top line is just beyond dispute. It was an absolute blowout.
a total blowout. Revenue hit $929 million.
Which is a massive 85% year-over-year increase. And management, they didn't touch their forward projections either.
Right, they left them alone.
Exactly. They fully reaffirmed their 2026 production target of, 860,000 to 940,000 gold equivalent ounces.
And the market definitely absorbed those numbers. The stock popped over 7% post-earnings, closing right around $134.20.
Yeah, but, the raw price action, that only tells half the story here.
For sure.
The underlying volume on that move is what actually signals where the smart money is going.
I actually noticed that, too. I mean, we are talking about roughly 667,000 shares traded on a day the stock jumped 7%. And the 90-day average for Wheaton is closer to like 2.1 million shares.
Yeah.
Usually, when a stock spikes after earnings, you expect to see retail flooding in.
You expect massive volume driving it through the roof.
Exactly. But this was eerily quiet.
It was quiet because it wasn't a retail-driven frenzy. When you see a significant price spike on lighter than average volume after a report like this, it points toward, well, conviction-based repositioning.
Meaning the institutions are just holding on tighter.
Exactly. Institutional holders, the funds that already own large blocks of Wheaton, they're adjusting their internal valuation models based on this new cash flow data.
Right.
So they hold on to their shares, they restrict the available float, and any buyers stepping in, they just have to pay a premium to find willing sellers. The institutions are digesting the mechanics, not just trading the headline momentum.
Well, we have a deep stack of analyst notes, transcripts, and technical data in front of us today for this deep dive, and our goal is to do exactly what those institutions are doing.
I'll look under the hood.
All right, we're looking under the hood of this record-breaking quarter to figure out for you, the listener, how much of this revenue surge was just handed to Wheaton by a favorable macro environment.
I mean, surging gold prices.
Surging gold prices, exactly. And how much was actual, repeatable, operational execution?
Because, honestly, it is remarkably easy for a mining-adjacent company to look like a genius when gold is sitting at historic highs.
A rising tide lifts all boats.
Exactly. Our job is to isolate the underlying business mechanics to see if the boat itself is actually structurally sound.
So let's strip it down to those mechanics. The average realized price for their metals surged 61% year over year to $4,443 per ounce.
Which is incredible.
Obviously. I mean, having the underlying commodity jump 61% is a massive tailwind, but they didn't just ride the price wave passively, right? The operational execution shows up in the volume.
It does.
Q2 production hit 202,229 GEOs, which is up 6.3%. And their sales volumes climbed even faster, up 14.4% to 209,115 GEOs.
Yeah, and we should probably clarify that metric for a second because it's so central to how this company actually operates.
The GEOs.
Right. Wheaton is fundamentally a streaming company, and a massive portion of their portfolio is actually silver or copper and even cobalt. But they report in GEOs gold equivalent ounces.
Right. They standardize it so analysts can actually compare apples to apples across quarters.
Exactly.
Like if they receive a shipment of silver from a partner mine, they calculate how much gold that silver could buy at current spot prices and report it as a GEO. It just, smooths out the reporting for a highly diversified metal portfolio.
Which makes tracking their margins much, much cleaner. And if you want to understand why institutional investors love the streaming business model, you just have to look at the profitability metrics from this quarter.
The margins were insane.
Cash operating margins hit $3,875 per GEO sold. That is a 65% jump in operating margin.
Wow.
And overall gross margins spiked 95% to $688 million. And operating cash flow, the actual cash hitting the bank account, came in at $650 million. Up 56.5%.
I always like to think of the streaming business model like owning a toll bridge during rush hour.
Right, where you're just collecting a fee for every single car that passes through.
But with a very specific, almost unfair twist.
Yeah.
You own the bridge, so you get the volume. But you also have this magical ability to instantly raise the toll price whenever traffic gets heavy.
Oh, exactly.
So when the macro environment pushes metal prices higher, you benefit from the increased traffic. The volume.
The higher fee.
Right, the spot price.
Yeah.
And the kicker is you never have to pay for the asphalt, the maintenance, the labor, or like the diesel fuel to run the heavy machinery.
Nope.
The traditional mining companies are the ones out there paying for the bridge maintenance and the heat. Wheaton just sits in the booth and collects the tolls.
And the math from this quarter backs up that analogy perfectly. I mean, consider the delta between two numbers we just mentioned. The year-over-year gross margin growth was 95%.
Yeah.
But the actual appreciation in the gold price was only 61%.
Yeah. That is a 34% gap between the price of the metal going up and their profit going up. I mean, how does a company expand its margins faster than the price of the product it sells?
It comes down to the mathematical leverage that's inherent in the streaming contract. You see, Wheaton doesn't operate mines.
Right.
They provide upfront capital to traditional miners in exchange for the right to purchase a percentage of the future metal production at a fixed, heavily discounted price.
And that cost is locked in.
Exactly. Because their delivery payments to those mining partners are locked in at a predetermined cost per ounce, Wheaton's cost structure is essentially immune to inflation.
Oh, right.
Yeah. When commodity prices spike, traditional miners see their diesel costs, labor costs, equipment costs, all of that spikes too. Wheaton doesn't.
So when the realized price of gold goes up 61%, almost every single dollar of that increase just drops straight through to their bottom line.
It is pure, unadulterated financial leverage.
Which explains how they are suddenly sitting on $650 million in operating cash flow from a single 3-month period.
It's a lot of cash.
It's massive. And for investors holding this stock, the immediate question is like, what is management doing with all this cash? They've clearly stated a 2030 growth target of hitting 1.2 million GEOs. So how are they deploying this windfall to secure that growth?
The short answer is they're deploying it aggressively, both in terms of financial scale and global geography.
Right.
On the earnings call, CEO Haytham Hodaly spent a significant amount of time highlighting the successful integration of the Antamina silver stream with BHP.
And this is not a small acquisition.
No, not at all. It is a $4.3 billion deal, making it the single largest transaction in Wheaton's history. Antamina is this massive copper and zinc mine in Peru, and Wheaton secured a long life stream of the byproduct silver.
But to understand why Wheaton has this kind of leverage, we have to look at it from the miner's perspective.
Yeah.
Like, why would a giant like BHP agree to give away their silver upside on a massive project like Antamina?
Especially since BHP isn't exactly strapped for cash. It's because BHP is fundamentally a copper and zinc miner. That is their core business. And building or expanding a megamine like Antamina requires billions of dollars in upfront capex.
Right.
Traditional debt is expensive right now, especially in a higher interest rate environment. And issuing new stock dilutes their existing shareholders.
Nobody wants that.
Right. So selling the byproduct silver to a streaming company like Wheaton is often just the cheapest, most efficient way to finance the heavy lifting. BHP gets $4.3 billion upfront to build out the copper operation. Wheaton gets decades of heavily discounted silver.
And Wheaton isn't just stopping in South America.
Yeah.
Looking at the notes here, they are actively diversifying their footprint globally.
Yeah, they just executed their first ever stream in Australia.
Wow.
It's a $275 million gold and silver stream on the Jervois project with KGL Resources. And on top of that, they've secured a foothold in Japan via the Sapanga royalty.
Japan.
Yeah. Management specifically described Japan as an underexplored jurisdiction for precious metals. And this specific royalty deal gives them optionality across 16 different development projects.
Okay, but wait. Throwing $4.3 billion at Antamina, planting first-time flags in Australia, rolling the dice on 16 different early-stage projects in Japan. I mean, we're sitting near the top of a historic commodity cycle.
We are.
Gold is trading at massive premiums. This feels dangerously close to reckless empire building. Are they just buying everything in sight because they have the cash?
It's a fair question.
I mean, they announced an 18% dividend hike this quarter, bringing it to 0.195 per share. But that only translates to a forward yield of about 0.6%.
Right.
Is throwing a 0.6% yield at retail shareholders enough to keep him happy, while management just goes on a multi-billion-dollar global spending spree at cycle peaks?
Look, it is a classic tension in capital allocation and a very valid fear for anyone holding the stock. But you have to view their spending through the lens of a streaming company's production pipeline. Streams are depreciating assets. A physical mine eventually runs out of ore. If Wheaton doesn't constantly replenish and expand its portfolio by buying new streams, its future cash flows will literally hit zero.
So they have to keep buying.
Yes, The Antamina deal is expensive, without question, but it locks in high-quality, Tier 1 jurisdiction silver for decades. It essentially acts as an anchor asset for the next generation of their business.
So the argument is that this isn't empire building, it's just basic survival.
Exactly. For a streamer, capital allocation is a treadmill. You can never stop running.
Right.
As for the dividend, streaming companies are inherently designed as growth and capital appreciation plays. They aren't high-yield income vehicles like, say, real estate investment trusts.
Yeah, that makes sense.
Management's fundamental argument is that reinvesting that $650 million of operating cash flow into new streams like Australia and Japan creates exponentially more shareholder value over a 10-year horizon than paying it out as a special one-time dividend.
And, to management's credit, they do seem to be managing their near-term inventory very carefully while they expand globally. The analyst notes heavily emphasize the PBND metric this quarter.
Ah, yes. Produced but not delivered. This is arguably the most crucial operational metric for a streamer's short-term health.
Because it's a buffer, right?
Exactly. It represents metal that has already been physically mined and processed by the partner company out in the field, but it hasn't yet been shipped and delivered to Wheaton for final sale. Right now, Wheaton's PBND sits at 158,000 GEOs.
Which, if we run the math on their current run rate, 158,000 GEOs translates to roughly 2.6 months of payable production just sitting in the pipeline.
Which is exactly where management wants to be. Their stated target range is keeping 2.5 to 3.5 months of inventory in that PBND pipeline.
Right.
Sitting at 2.6 months means they have a very healthy, reliable operational buffer heading into the second half of the year. Because the reality of mining is that things go wrong. If a partner mine has a localized labor strike for a week, or if a global shipping route is delayed by weather, Wheaton has enough produced inventory already in the pipeline to smooth out their quarterly sales numbers.
So they won't miss an earnings estimate just because a cargo ship was a week late.
Precisely.
Okay. But if they have a 2.6-month operational buffer and their gross margins are expanding by 95%, you would logically expect the stock to be trading at all-time highs.
You would.
But it's not. It's actually sitting around $134. That is a nearly 20% discount from its 52-week high of $165.76.
Right.
So what specific shoe is the market waiting to drop? What risks are institutions actually pricing into this stock to justify that kind of discount?
Well, the most immediate risk is the structural timeline of their own guidance. We established earlier that management reaffirmed their full-year target of 860,000 to 940,000 GEOs.
Yeah.
But if you look at their actual first-half production, they only delivered 415,000 GEOs.
So in the first 6 months of the year, they only hit about 45 to 48% of their full-year target.
Exactly. The math demands a massive, heavily back-end weighted ramp-up in the second half of the year.
Okay, that's stressful.
Very. Hitting that 860,000 floor relies entirely on production surges at very specific concentrated sites, primarily Peñasquito in Mexico or the Salobo mine in Brazil. If the operators of those mines miss their internal Q3 or Q4 targets, Wheaton physically cannot meet its full-year guidance.
And that brings us directly to Salobo, which seems to be the linchpin of their entire portfolio.
It really is. Salobo is Wheaton's largest single asset contributor. It's a massive copper deposit in Brazil operated by Vale, and this highlights the inherent concentration risk of the streaming model.
Right, because they don't run it.
Exactly. Wheaton is completely tethered to the operational competence of one specific mine operator at their most important asset. If Vale runs into technical throughput constraints, say the ore grade drops, or the grinding mills require unexpected prolonged maintenance cycles, it disproportionately damages Wheaton's quarterly stability.
So you essentially outsource your operational risk, but you also outsource your operational control.
You do.
Like, if Vale decides to shut down a processing line for 3 weeks to upgrade a conveyor belt, Wheaton just has to sit there and watch their PB&D metric shrink.
Add to that the geopolitical and legal overhangs that come with outsourcing your operations globally.
Right.
The earnings reports highlight an unresolved, ongoing legal dispute with the Canada Revenue Agency, the CRA. This is a complex fight regarding the taxation of foreign subsidiary income.
I was looking at that. How does that actually work? Why is the Canadian Tax Authority going after a streamer for mines in Brazil and Peru?
Well, streamers often set up subsidiaries in jurisdictions with favorable tax structures to manage the upfront capital investments and incoming cash flows from these international mines.
Right, makes sense.
It's standard practice to maximize the efficiency of the capital. But the CRA routinely challenges these structures. They argue that the income generated by those foreign subsidiaries should actually be taxed at Canadian domestic rates, claiming the core management and value creation happens in Canada.
So it boils down to transfer pricing and international tax treaties.
Exactly. And if the CRA wins, it could result in a massive retroactive tax liability dropping directly onto Wheaton's balance sheet.
Man. And it isn't just Canadian regulators causing friction either. There are legislative shifts and severe permitting delays happening right now in both Mexico and Brazil.
Oh, yeah, huge delays.
And these delays directly threaten the development timelines of several of Wheaton's key mining partners.
That regulatory friction is the hidden, unhedged cost of the streaming model. You don't have to operate the mine, you don't have to hire the local labor, but you are completely at the mercy of the host country's bureaucratic permitting process.
Right.
If a mining partner's environmental permit for a new expansion phase is delayed by 2 years in Mexico because of a change in local government, well, your cash flow from that specific stream is delayed by 2 years.
Wow.
There is nothing management in Vancouver can do to speed up a municipal permitting office in Zacatecas.
So heading into this earnings report, the bar chart technical opinion actually showed a 40% sell signal on Wheaton. When institutional bears are modeling out the next 12 months for this stock, are they more afraid of the CRA tax liability resulting in a massive financial penalty? Or are they more concerned about a physical, operational bottleneck at Salobo?
Based on how institutions trade these stocks, the operational bottleneck at Salobo is the far more immediate, tangible fear.
Really? Not the tax thing.
No, tax litigation with the CRA is notoriously glacial. It can drag on for years through various appeals courts and tribunals. Markets tend to heavily discount long-tail legal risks because the timelines are just so unpredictable.
But Salobo.
Salobo hits the income statement next quarter.
Right.
If throughput drops at Vale's operation in Brazil, the back-end weighted guidance collapses, the math fails, and the stock gets punished immediately. The technical sell signal heading into earnings likely reflected a widespread lack of conviction that Vale and the other partners could actually deliver that required second-half ramp-up.
The strong Q2 numbers clearly eased some of that immediate fear, which is why we saw the 7% pop on conviction buying. But, the pressure to execute flawlessly in Q3 and Q4 remains immense.
It puts any investor looking at the precious metals sector in a really fascinating position. You have to carefully weigh this incredible, almost unmatched financial leverage against some very concentrated operational and geopolitical risks.
And that tension leads to a much broader, almost philosophical question for you about the mining sector as a whole right now.
Yeah, it does.
Just look at the metrics we walked through today. Wheaton's gross margins jumped 95%, primarily driven by a 61% increase in underlying metal prices.
Yep.
To achieve that 95% margin expansion, they didn't have to buy a single new Caterpillar haul truck. They didn't have to negotiate a contentious new union labor contract in South America.
Not at all.
They didn't have to pay double for the diesel fuel required to move millions of tons of rock.
For anyone allocating capital in 2026, you have to look at the structural reality of the industry. We are in an era of ballooning capital expenditures. It costs billions more to build a mine today than it did 10 years ago.
Right.
We're dealing with sticky structural inflation across the supply chain and rapidly rising labor costs for traditional mine operators.
So you really have to ask yourself, is the traditional mining stock becoming obsolete?
It's a valid question.
Right. When you can buy the pure, unadulterated financial leverage of a streaming company, a model that captures all the upside of the commodity cycle while completely insulating your balance sheet from cost inflation, why would you ever take on the heavy, capital-intensive operational risk of a traditional miner?
It really is the ultimate question for the sector right now. Why pay for the asphalt when you can just collect the tolls?
Exactly. If you want to keep tracking this earnings season with us, make sure you follow the show for daily, no-nonsense coverage of the most important reports on the market. We'll keep watching the traffic on the bridge so you know exactly when the tolls are going up